Welcome to the Interbank FX live webinar series. I'm Raghee Horner, the Chief Currency Analyst at Interbank FX, and I'm very happy, I'm very excited to be talking about directional bias today. Now, directional bias, and I'm going to go ahead and define it before we go ahead with our talk. Directional bias is basically a concept that I've always used, but like so many things that we use without having taught anybody, we tend to do these things kind of subconsciously. There's probably a lot of things that you do on your charts right now without consciously thinking about it. And when you do these types of things, it's difficult sometimes to break it down into the individual components. And it was about maybe 4 months ago that I found myself in a situation where I was teaching somebody here in my trading office, and I had the daily chart up, and basically what had happened is the daily chart was indicating a sideways market. And usually in a sideways market, I'll at least respect the floor and ceiling, and this person here in my office said, I want to go long, and prices were right up against the ceiling. It happened to be a ceiling in a distribution market. So because of that, I ended up telling him, I'm not really keen on that because of the ceiling. And he said, well, what ceiling? And I said, the ceiling on the daily. And he goes, oh, I didn't realize you were using the daily. And I said, gosh, sometimes I'll use tools and I just kind of assume that a lot of people will look at the same thing. And that's my first mistake. I should never assume. So directional bias and this whole idea is something that's not even in my books. This idea of directional bias is actually something, again, I kind of discovered what I was doing and realized that, okay, I better start spending some time discussing it because it's something I really haven't talked about before. Directional bias is not multiple time frame confirmation, okay? And I have talked about multiple time frame confirmation before. In my books, I talk about it as a tool that I don't use. And let's define multiple time frame confirmation. Basically, the way I've always seen it being used and the way I understand it, and obviously like any trading tool, there's multiple explanations and multiple descriptions and uses, but essentially multiple time frame confirmation is using a larger time frame to confirm the direction of a smaller one. And daily directional bias isn't really telling me that I need to trade, I have to trade in a certain direction. It's letting me know when I'm fighting the larger psychology. Okay, so directional bias is more about making sure I'm not fighting the current, and if I am going to trade counter the trend, I'm going to do so in a shorter term time frame. So now that we've got a decent idea, I hope, of what we're going to be talking about over the course of this presentation, if you have any questions on directional bias as I'm going through it, please let me know. I'll be happy to go ahead and stop and answer those questions. My only request is please keep the questions on topic, and that way we can thoroughly cover this directional bias idea. All right. Now, I think the discussion for directional bias is particularly timely because I've been getting a lot of comments and questions regarding the current market and the perception to a lot of traders that right now it's exceedingly difficult to be trading. And I think in large part this comes from a few things. One, I think number one, the first thing is a lot of traders are trading the euro US dollar. And the way that we pull back, the way that price action sunk into the wave and the way the wave began to transition, I think really frustrated a lot of traders both intraday and end of day. First of all, this correction lower in the euro US dollar, in my opinion, was fueled primarily by the rally in the dollar index. On the 2nd of February, the dollar index bottomed, and for basically the next 12 days, from the 2nd to the 14th, we continued to rally on the dollar index up until the point that selling pressure at 79 began to create a ceiling that the bulls were simply not able to overcome. Now realize, for those of you that are familiar with my daily trading edge discussion of the Forex market pulse, of the presentations we've done regarding those handful of futures contracts that have a terrific correlation back to Forex. And one of the things I'm always very thankful for was the fact that I was introduced to Forex after over 15 years of, about 12 to 15 years of futures trading. So I brought a certain amount of knowledge from the futures arena into my Forex participation. And the things that I carried over were understanding how the Dow and dollar worked, and then understanding the correlations that the Dow, dollar, gold, crude oil, the continuous commodity index, all futures contracts that I was very familiar with, correlated back to the price action that I saw in the currency pairs. And that's what I call my Forex market pulse, or Forextra. So a lot of the pullback that we saw in the dollar, in the euro US dollar, was due to the rally in the dollar index. By the way, the same goes for the British pound. And you guys know here, if you've been joining me for any length of time in our live series, and I recognize a lot of the names here. I'm not sure how many people are here for the first time, by the way. If you're a first-time visitor, you're in a great group of people. We have a lot of regulars here in our weekly get-together. If you're brand new to our webinars and IBFX, welcome. You know, you're with a great group of people here. We usually have a really solid discussion, not only of the topic each week, but also, if you notice, I loathe PowerPoint. It's just not something I've ever gotten very comfortable with. So if I have notes I want to share with you, I'm just going to throw Word up, and we're just going to type up the notes together. I'd rather stick with the live charts, and this is actually the IBFX Trader 4 platform you're looking at right now. This is current price action you're seeing right now. So that's what we focus on here. And again, if you're new, welcome. Please feel free to ask whatever questions you may have. And you know, we tackle a different topic each week. And this is a service we do exclusively for clients of IBFX. So again, thanks for your time. So if you've been reading the Daily Trading Edge, I've been talking a lot about the pullbacks in the euro US dollar. I've been talking about the pullback in the cable, as you can see here. I've been talking about the distribution range in the dollar yen. I've been talking about the distribution range in the Swissy, US dollar Swiss franc. These are all topics that have been running fairly frequently and fluently through the Daily Trading Edge over at IBFX.com. And these are all right now on the daily time frame, because the pullback on the daily US dollar index has made these corrections in what were very clear market trends. Now, when we talk about directional bias, it's a very simple way of saying what directional bias is. It is what is the market trend, the phase or the psychology on the daily chart. That's it, you know, but directional bias sounds so much more sophisticated, doesn't it? But I think it's a better description, okay? Because there is a bias to the direction. You know, there's a psychology behind it. There's a certain amount of a dominant psychology that we have to respect, even when we are trading shorter term time frames. Now, the shorter the time frame, the less in many ways we're really exposed to the directional bias, because of how brief we're likely to be in a 5-minute trade, for example. Okay, but the longer the time frame, the more relevant that dominant psychology becomes. So directional bias will let you know when you're counter trend trading. It will help narrow down, at least that's what it does for me, helps narrow down the time frames that I will consider entries on, in which direction I will take the entries on. And it also helps me in the case of, for example, what we're seeing on the dollar Swissy and the dollar yen right now, helps me identify the distribution range that we're seeing. Now, I talked about distribution range on the daily trading edge today. So if you head on over to ibfx.com and you take a look at the update that I posted today, and I will go ahead and bring that up here in just a moment, you'll notice that I talked about the directional bias of the dollar Swissy and dollar yen. Head on over to ibfx.com and let me share this view with you. Just bear with me a moment here. There we go. So if you head right on over to the home page, what you'll see is, well, my mug, Daily Trading Edge. If you click on that, today I talked about and described this distribution range concept. There are 4 market trends, and this has everything to do with directional bias, because directional bias is just another way of discussing market trends particular to the daily time frame. Okay, so if you notice, we're looking at the daily on our charts right now. So let's use the daily dollar Swissy, for example. Right now, if I take a look at the daily time frame and key in on these 3 moving averages, and let's talk about the studies that I've got on the charts right now, on this particular chart. There's a website at ibfx.com, and I'll share that with you as well. And it's where all the tools downloads are. And I have a tool that IBFX has designed called the grab tool. And I believe I've shared that link in the past with everybody here. Let me see if I can bring it back up. Just bear with me. Okay, so you can download this tool from IBFX called GRAB. GRAB stands for green, red, and blue. All right, you can download that tool. What that will do is put the color-coded candles as well as the 3 moving averages you see on my screen. Now, on the plug-in, I believe it makes them like hash marks, as you can see here in the image. I just make them solid, and you can go ahead and change that in the study if you'd like. Some people like the more subtle lines. It's really up to you, but it will go ahead and install the 34 EMA wave as well as the color-coded green, red, and blue. So those are the indicators that I've got running, as the studies that I've got running on my charts. Okay, and again, you can download those for free over at ibfx.com. So you can see those are the tools I've got running here. Now, there are a few other moving averages that I like to add. I don't know that we'll need them for our discussion here, but in general, when you look at some of my charts on the web and specifically at the Daily Trading Edge, you'll notice there's often 6 moving averages in total on the chart. The 34 period EMA on the high, close, and low, which is the red, green, and blue lines of the grab. I'll also have a 20 period simple moving average, a 50 period simple moving average, and a 200 period simple moving average. Okay? So those 6, and of course, again, the grab and the grab tool, the grab download will put the EMAs of the wave on your charts automatically, but if you want to set them up manually, it's the 34 period EMA on the high, the 34 period EMA on the close, and also 34 period EMA on the low. All right. But the grab gives you the color-coded, which I like a lot as well, because I think it's just another visual cue to help identify sentiment, momentum, and eventually trend. So take a look at the wave, the trio of moving averages here, and you'll notice they're moving more or less sideways. Now contrast that with the angle on, for example, the cable that I have continued to swing by since the angle was moving up higher. I call this a 12 to 2 o'clock angle. It's a mark-up trend for those of you that are familiar with, say, Dow theory. It's an uptrend. And within the context of an uptrend, I will look for opportunities to buy into corrections. And I've been talking about that since we started pulling back into the wave, going back to even the end of January. Okay, and every time we correct into the wave, it's another opportunity to trigger a swing buy. Now the directional bias, the market psychology, the trend of the daily is up. Now what this directional bias will mean to you, and let's go ahead and just jump on over to Word here for a moment, and let me just list some of the ideas here. So let's jump on over here. Okay, so directional bias is the daily time frames market trend. And the market trend is another way of looking at what the psychology is of the market. So, for example, we're looking at the current cable's directional bias, and it is up or in a markup trend. Okay? In a markup, when the daily is indicating strength like this, what I want to do is realize that there are essentially 5 time frames, actually 6 if I include the 5-minute, but I got the 5-minute, the 15-minute, 30, 60, 240-minute or 4-hour chart, and then of course the daily. And these are the time frames that I will scan or do my triage on to look for the clearest market psychology. And for those of you that join me for that triage discussion and how we scan the markets, that's what we're talking about here. Okay? So when we're in a markup, the short-term time frames, and when I talk about short-term, let's define what I mean by that. I'm talking specifically about the 5, the 15, and the 30. Okay? What's short-term to me? Long-term is 60, 240, and of course, daily. Okay? Now remember, the directional bias is taken exclusively off of the daily. So because I have that mark up right now on the cable, all right, and let's paint that green since it's a mark up, right? So I have that mark up right now. What I want to keep in mind is that I can trade with the trend. So with the trend would be what? To look for buying opportunities, right? However they may be, momentum buys, swing buys, whatever it may be, opportunities to get long. If I'm going to go counter trend, for me counter trend is against the daily trend, in which case with the cable is up. Okay, if I'm going to do that, then I'm going to limit what would be a short sell. Okay, again, because the cable is in a markup right now, I will limit my short sell entries to the 5, 15, and the 30. So if I'm going to go against the trend, if I'm going to go counter trend, I'm going to do so only on those short-term time frames. This is a very important point when it comes to the value of directional bias. I'm not going to swim upstream. Swim upstream means I'm looking for longer-term counter-trend movement on, say, that's 60 or 240. All right? So again, going back to the cable and what it's been doing, what I want to consider is the directional bias is up. So on these days, and of course I'm not saying you can't go short. That's not what I'm saying at all. Okay? On those days where we had these significant pullbacks, there's days where we had good strong pullbacks. On those sessions, on those days, and there was quite a few days, we have the weakness. What I'm saying is if you want to look for short selling opportunities, look for them on the 5. Look for them on the 15 or the 30. Realize that you're swimming upstream, that you're fighting the trend of the market, the dominant psychology of the daily. And then when you do want to do that, do so in a way that leaves a certain amount of, you can be nimble. You're not reliant on longer term counter trend movement. The daily directional bias of the cable right now is dictating that if you want to be long, you can do so on any one of those time frames, 5, 15, 30, 60, 240. But if you want to get short, you limit it to the 5, 15, or the 30. Let's use another example here. Let's break down what's happening on the dollar Swissy. Talk about that in a moment, because the dollar Swissy is not in an uptrend or downtrend on the daily chart. What do you do when there's no trend? In other words, there's not a bullish or bearish overall sentiment. We're stuck in a range, a distribution range in particular. Okay. Now, if you take a look at the daily trading edge, and I define what a distribution range is in today's update for the 17th, for February 17th, and I said a distribution range is a sideways range that occurs as price moves in a wide, volatile range. The 34 EMA wave moves in a 2 to 4 o'clock clock angle. Within this market trend, prices have a tendency to stall at the floor and ceiling of the range. And because of that, I will fade these levels, which means I'll buy into floors and sell into ceilings. Okay? So in a sideways market, which is what we have on the dollar Swissy and on the dollar yen on the daily time frame, there's a few things that I want to do. One, I want to identify what that range is. I want to identify what it is that I'm looking at in terms of where the exhaustion, where the sentiment shift could kick in. So there may not be one magic level. I realize there could be multiple levels where past price action has exhausted, and that will create these layers of resistance. Okay, we could have layers of support as well. Again, we don't have to necessarily be in a situation where there's a perfect double top or double bottom or triple top or triple bottom. We have to realize there could be multiple levels within the market's memory where prices could exhaust. Okay, the way we determine which one of these levels is most likely to be, as I'd say, in play, is I could use a secondary indicator like a stochastics to help identify overbought and oversold levels. There's no magic bullet, obviously, but if I want to help narrow down the levels at which I feel we could be getting that exhaustion, the stochastic is a great tool to do it. So on the daily Swissy, the directional bias is what? Let's go back over to our note-taking pad here. So now we're talking about a non-trending market. So the first thing we have to figure out, is it a wide volatile range or is it a narrow quiet range? Because that's the difference between distribution, where I'll expect exhaustion at the floors and ceilings, versus accumulation, where I'll look for momentum, breakouts and breakdowns through the floors and ceilings. So that's the first decision. There's two types of non-trending markets. That's the first thing I need to find out. So in a sideways market, again, I need to figure out which kind of sideways market it is. Distribution has a 2 to 4 o'clock clock angle, while accumulation has what I call a flat or 3 o'clock clock angle as far as the angle of the 34 EMA wave. All right. Oftentimes in accumulation, the grab candles will be predominantly blue. Okay. In distribution, we'll have all of the candles kicking in. We'll have blues, we'll have reds, we'll have greens, because the range is wide enough where prices could get above and below the wave. Okay? Accumulation usually dominates. Blue usually dominates because of the quiet range. Usually. Okay, these are just generalizations. So depending upon what type of non-trending market we have, we're going to expect different types of reaction at the floor and ceiling. As I mentioned, the dollar Swissy was in distribution, is in distribution. You can see the waves a little lumpy. It's not flat. It's not flat in 3 o'clock. It's got a little bit more of a wave. I should say lumpy and bumpy. It's got a little bit more movement to it. The movement of the wave in this lumpy, bumpy manner indicates wider volatility, a wider range, higher volatility. Okay. So I go about identifying the floor and ceiling of the range. Now realize, again, multiple levels of resistance, multiple levels of support. I can utilize the stochastic indicator to help narrow down where the market could, in fact, exhaust. So I'll go over to my indicator drop-down menu. All right. I'll head on over to the stochastics oscillator. I like using a very slow setting, to 21 setting. You should notice the indicator there. And what I want to do is identify where I could start looking for opportunities to take advantage of exhaustion at the ceiling as prices headed up into it. Now notice, this is where we headed up into the ceiling, right there. Okay? All I'm looking for the stochastic to do is indicate to me whether or not it's overbought or oversold. I'm not interested in any kind of crosses. I'm not really looking for anything other than just a confirmation that as we head up into the ceiling, there's a chance that we're looking at an environment where there's a likelihood of exhaustion. Nothing more, nothing less. Okay? So it just confirms to me that, yeah, I'm looking at a level that could be a decision level offering me a stall and or potential reversal. So again, all this starts because of the distribution range. Okay? All this starts because of the distribution range. And as I mentioned a few times that I've talked about distribution on today's Daily Trading Edge, and what the psychology is behind distribution, if I had to define distribution, or had to define all four, a markup trend would be what? An uptrend is what? Greed, right? A mark down would be fear. If I'm going to narrow these down into very basic psychological type labels. Accumulation, the quiet sideways movement, could be considered boredom, or even a certain amount of just, disengaged. Balance even would be a great word for accumulation as well. Distribution, I think, is best defined as confusion. And a confused market does not have the organization of sentiment and momentum to turn into a trend. We have the price movement. We certainly have emotion, but we don't have the organization of it. You know, there's a certain amount of organization behind a trend. We lack that in distribution. There's a certain amount of organization required for a breakout or breakdown. But again, we lack that in distribution, which is why I think distribution is best described as a certain amount of confusion in the market, which is what leads to the exhaustion that I look to capitalize on as prices reach the floor and the ceiling. Okay? So when we reached this area up here, let's talk about directional bias. What was our directional bias? It was a wide volatile range. It was distribution. It was non-trending. Now in a non-trending range, when I want to go intraday, for example, on the Swissy, as prices were rallying up into or close to the ceiling, I have no problem getting long or short on any of the time frames within distribution. My recommendation for distribution is you must, and this is where I think the directional bias and understanding and defining the range, the multiple levels, often multiple levels, floor and ceiling, is as we get closer to these exhaustion levels, go shorter term. That's it. Go shorter term. If you are looking longer term, let's say you've been riding a 240-minute or 60-minute or 240-minute time frame. If you're trading and we're closing in on that level, you must respect the range of the daily and hopefully do a few things. One, start to minimize your position size by doing what? If the trade's going in your favor, start to peel out of that position, realize some profit. Okay? Because a sentiment shift could be coming. You can still take advantage of a rally into a ceiling. For example, as the dollar Swissy rallied into the area where we were starting to suspect that prices could begin to exhaust. It's a wide area, right? All I'm recommending is not necessarily that suddenly you need to get short. I'm not saying that you can't take advantage of the movement higher as we near or in this area. What I'm saying is start to go shorter term so you're nimble. Short-term time frames are more nimble. Okay? I don't want you reliant on longer-term organization in this exhaustion area, whether it be the floor or the ceiling. Okay? So we had the overbought scenario. We were up in that exhaustion, layers of resistance, that exhaustion area. Okay? And, you might find yourself not necessarily trading the daily time frame. All I'm saying is recognize the distribution market trend on the daily so that you're better prepared for these shifts when they occur, like what we see on the dollar Swissy, rather than being longer term long, 60 or 240, you can be shorter term long and or play the exhaustion, the distribution fade on the daily time frame. Now, distribution fades in terms of their entries, regardless of the time frame that you're trading them on. Basically, what you're trying to do is identify, again, a ceiling, a level at which you feel price action will exhaust. Okay, there's multiple levels here. When it's a wide area like this, it's trickier because essentially your point of validity for a distribution fade is about 10 to 12 pips above the highest high of the range and 10 to 12 pips below the lowest low of the range. So if you get in aggressively at a lower level, at a lower layer of the exhaustion at the ceiling, or if you get long at a higher level, a higher part of the layer of the floor, realize you also have more risk because your stop loss is really based upon the extremes of the range. Does that make sense to everybody? It's the extremes of the range. So the more aggressive you are, the more heat you're liable to take. One recommendation in order to get long at those levels, because realize we didn't hit the highest high here, did we? We exhausted just before that. So what you could do is think about your overall position size, and at those aggressive levels, the lower part of the ceiling, the higher part of the floor, the more aggressive entry, enter with a smaller position size. And as we get to the more conservative levels, you can increase your position size. So I might only enter aggressively with 1 lot or 2 lots, something small, just to get a taste, just to be in the game, to have some skin in the game. But as I get closer to a conservative level, I'll go ahead and enter with what I would typically want to be in terms of my position size. The same thing goes for swings, by the way. You know, I think I've discussed this regarding the cable swing by, that essentially the wave is my conservative level, but as an aggressive level, I will also often have the 20-period simple moving average running on my chart. Okay, and that will be an aggressive level. So in essence, I'll often have a swing buy zone where the 20-period simple moving average would be an aggressive buy in this uptrend, and the 34-period EMA on the high would be the more conservative level as prices sink into the wave. Okay, but again, in the situation where I have a trend, an uptrend in this situation, I don't want to be fighting the trend, the dominant daily psychology. I don't want to be fighting the trend or trading counter trend on a longer term time frame. If I'm going to do so, and do so on a nimble intraday time frame, 5, 15, 30. In a situation like the dollar Swissy, where I don't have a dominant psychology at all, do I? What I need to respect, instead of the trend, what I need to respect then is the highs and lows of the range, and not position myself in such a way that I'm expecting a longer term organization, or I'm expecting the range to be broken because of my longer term trend follow or my longer term time frame entry. That's a big part of, I think, why a lot of traders get burnt. They'll get long in a longer term time frame right up here in the ceiling, and yes, the trend was up, say on a 240, right? I mean, there was no argument that before we exhausted, there was definitely an uptrend on the 240, right? So a lot of traders would think, oh, great, here's an opportunity to get, look at the hard right edge of this chart. Oh, great, here's an opportunity to get long. You know, here's that buy zone between the 20-period simple and the 34 EMA on the high. But what were they missing on the daily chart? And you can see these red lines. We were right up against, we were right close to where that exhaustion ceiling was kicking in. In fact, we'd already been rejected from it once, and here, boom. You know, what looked like a tremendous trend follow really ended up being a buy right in front of where the market sentiment was exhausted. The bullish sentiment was exhausted. Does everyone follow me there? So in the sideways range distribution, you have to be keenly aware of this. I will say accumulation is extremely tricky to trade. In fact, when we have a very narrow, quiet sideways range on the daily, which I don't know that we have right now in any of the pairs, but when you do have a quiet, narrow, sideways range, my advice usually is to stick with the very short-term time frames, 5s or 15s, because the narrow nature of the price movement range will oftentimes give you a trigger, but not enough price movement for a potential follow-through. Okay, so when you're in those sideways ranges, very tight ranges, I think right now, and this is not a pair that I trade with any frequency whatsoever, okay, but I do believe that it is in a narrow range, the Euro Canada, the Euro Canadian dollar. See how we're flattening out on the wave, and see how small these candles are? What happens is, yes, we've got a quiet range here, but in the short-term time frames, even those are having a difficult time getting some sort of clarity of psychology in order to help set up a trade. So just be very aware that when you have a situation like that, what you want to do is likely just kind of wait or play the momentum breakout or breakdown. Accumulation ranges, quiet sideways ranges, often don't leave enough pip movement. It just doesn't have the volatility. So usually my advice is just to steer clear of those. And they don't happen very often on the daily time frames, that quiet, that indifference, that balance. It doesn't happen a lot, okay, on the daily. But when we do have it, respect it and don't demand that the price range increase just because now you want it to. In other words, don't demand that the daily chart increase in volatility simply because you've entered on a longer term time frame that needs that breakout in order to follow through. Don't put yourself in that position. Find another pair or trade it on a very short term time frame, like a 5-minute. You know, we've got plenty of video about the 5-minute between the greens entry that I use. I've given you all every detail of that entry. It's a very simple entry, one that takes advantage of very, very short-term intraday trends. Okay, so again, our topic here is about understanding and respecting the daily time frame as a reflection of the overall psychology of the market. And what you want to do when you have these situations is essentially give yourself an opportunity to examine each time frame within the context of that trend or non-trending market, understand whether or not it's close to the floor or ceiling, understand whether it's, you know, whether the individual time frames are moving with the overall directional bias or against it. If you're moving against it, again, my advice is go short term. If you're in an accumulation range, go short term. Again, 5s, maybe 15s. When you're up against the top or bottom of a distribution range, again, go short term. But if you're trading within a healthy uptrend, like what we see on the cable, you know, all the time frames really are fine for buying opportunities. And if you are going to take advantage of any kind of short sell, go short term, right? So again, the distribution fade and the swing buys seem to be what's dominating most of the majors right now. At least that's been my experience, and that's what I've been writing about on the Daily Trading Edge back at the website. Does anybody have any questions? All right, so I see here a question regarding the distribution range stop. Again, it's 10 to 12 pips, but from the extreme. You know, basically you identify the highest high and lowest low of the range, of the distribution range, and you want to be just beyond that ceiling or floor. Okay? And sometimes, again, it may be such a wide layer of support or resistance that you may pass and say, you know what, this distribution range looks great, but the risk that I take by getting in aggressively because of the width of the range at the exhaustion levels just may not be right for you, you know. And let me add that distribution fades are always aggressive entries, always to me. They're not one of my 3 core entries. My 3 core entries are trend following, momentum breakout and breakdowns, and trend reversals. Those are 3 cores. The distribution range is a 4th entry strategy, but it is always aggressive. Okay, let's see. When the price is rallying into the ceiling, or, for example, the dollar Swissy, okay, with the momentum, sure. Let me head on over there while I'm reading this question. And I'm planning to short into the ceiling. And notice on the Swissy there was multiple levels where the ceiling could create the exhaustion. It wasn't just one level. It's very seldom going to be a single level that's cleanly showing you where prices have exhausted before. It's seldom going to be that easy, okay? Let me just say that also. How do you know it's not going to break the ceiling? We don't. There's no way I know. It's just that I have to trust that in a distribution market trend, when I have a wide range and I have that 2 to 4 o'clock market trend on the wave with the greens, the reds, the blues, all in succession like they are here, I have to trust, and that's part of the entry strategy, I have to trust that chances are prices are going to exhaust. There's no way we can know. There's no way I know a trend is going to continue after correction. There's no way we know anything about what's going to happen tomorrow in the market. The distribution range is no different, okay? But again, it's the same type of fear, and you're right, it is a scary type of entry. Absolutely, I'm with you there. It's the same type of fear I have when I was buying into the pullback on the cable. You know, I won't kid you. I've been doing this for years, and every time I buy into a pullback, especially consider this first swing trade. This very first swing trade. I believe I talked about it at the Daily Trading Edge as well. That was when, if you all recall, the GDP came out of the UK, and it was terrible. This abysmal number sent the cable just flying lower into the wave support of what? An overall bullish directional bias. Well, when I have the psychology predominantly bullish, I know that in an uptrend, I want to buy into support. And that's exactly what I ended up doing. Now, was it scary? Oh, absolutely. Absolutely. There was nothing comfortable about it. Just like when I started shorting into the dollar yen, which wasn't nearly as neat and clean as the short on the Swissy. As far as the distribution range goes, the same type of market psychology on the dollar yen, only the dollar yen was just absolutely bent on going and testing 84. And I realized that with that major psychological level, that 00 overhead, that was something that prices may do, run the stops up to that area. That's exactly what happened until we started to weaken. And we really haven't accelerated, have we? The yen has not regained a lot of footing on the dollar. If anything, the dollar seems to just be slipping against the yen with today's weakness. But, you know, again, the distribution range is what I'm keeping an eye on. Remember that, and this is something to keep an eye on, directional bias isn't fixed. You know, part of directional bias and understanding the daily psychology is there's slight hints when a distribution range might be getting bullish enough and changing the angle of the 34 EMA wave into a fresh up or downtrend. I have to be very aware of that, most especially on the dollar yen right now. Okay, I still believe we're in distribution. Okay, but I've got to remember that if we continue to establish a few more sessions of higher lows, there's a very good chance that the 34 EMA wave could start to look at a fresh transition into an uptrend. Okay, so remember, these aren't fixed. We've got to go back and reassess and make sure that we're not in a situation where we're applying a strategy that may no longer be valid. Okay, so the Swissy isn't really in danger of that, but the dollar yen, I'm definitely keeping an eye on that. I still feel the exhaustion fade is the way to go, the distribution fade, but again, I can see that it may not take very much to complete what could be a shallow, fresh uptrend on the dollar yen if the yen cannot start to gain back on the dollar. Okay? All right, any other questions? Okay, I've got a question about psychological levels here. So the psychological levels can be part of the distribution range. You know, any significant floor or ceiling can be part of a distribution range, but the 84 level wasn't necessarily part of the range. It was just a psychological level that I knew could be resistance. I don't think it was part of the range here. The range basically up until the high that we made up at, what was it, like 83.97 or 83.98? Up until we made that high, I realized that we were so close to the 84. I realized that past highs were like 83.70, 83.90. So I knew that we were, you know, just close enough to the 00 that it could help us with some selling pressure to keep the exhaustion range exhausted. Okay, so I don't think we knew it was not necessarily part of the range in terms of the price, but it was part of the range in terms of our anticipating that a major psychological level overhead could act as a ceiling. Okay, all right, let's see. Regarding the 2050 200, I've got a question here. Could I please explain what the 34 EMA, 20 SMA, 50, okay, these are all moving averages. What do they say about the trend? You know, for me, when I put these indicators within the context of the market memory, the angle at which they're traveling, more particular to the 34 EMA wave trio, the angle at which they're traveling, I believe gives me an indication into the underlying psychology of the market. The 20, 50, and 200 period SMAs, the simple moving averages, these are moving averages that are so well watched across really any market, stocks, futures, forex, that it behooves me to watch them because I think there's a certain amount of psychological relevance, market relevance to those three moving averages. But the 34 EMA trio, the angle at which they travel is the way I try to identify which one of the four Dow theory market trends that the market is in. Thank you for your question. Would I swing the daily or the 240? Which pair, Bobby? If you could let me know. I know we've jumped between the Swissy and the yen and the cable quite a bit. So I'm assuming you mean the cable, since that's the one that's in an uptrend. As far as the time frame goes, what you must remember is that we still need the basic elements of a solid trade, meaning good market psychology clarity, a good healthy angle of the 34 EMA wave. The choice between which time frame we're going to trade comes down to which one is giving us the clearest indication of the market psychology. So the smoothness of the wave we'll consider. How established is the wave at that clock angle? We'll consider that. If there have been past pullbacks in an uptrend or past bounces in a downtrend, has the wave offered the dynamic support or resistance? So those are all things that come down to the triage discussion that we've often had. Okay, that's all triage. The cable, again, so hopefully I answered that question for you there, Bobby. As far as the swing trade, the stop loss on a swing trade, I got a question about the stop loss on a swing trade. And again, I would highly recommend, for those of you that have never seen any of my presentations before, I would highly recommend that you all check out the YouTube channel that Interbank FX has, because we have a lot of videos at the YouTube channel that you can check out and catch up on some of the nuances of some of my other strategies. So with that in mind, let me just show you real quick. Okay, if you go to youtube.com// Interbank FX videos, there are literally dozens of videos there with the webinars we've done throughout last year. I believe we're getting some of the videos from this year up and running, so a lot of information there at the YouTube channel. Okay, so in terms of the swing, the point of validity, when I call where the trade is no longer valid, is actually below the 34 EMA low in an uptrend and above the 34 EMA high in a downtrend. So thank you for your question there, Chuck. The white line on my chart, for those of you that might have joined late, is the 20 period simple, and I was using that as an example of how oftentimes there are aggressive levels within the context of a pullback you could consider before prices get to the conservative level of the wave. Okay, and again, the moving averages that I'll often have on my charts, of course, are the wave, the 34 EMA on the high, the close, and the low. You can download the study that I'm using at Interbank FX. Let me actually give you guys the link here. There it is. Okay, so you can download this tool, not only the wave, but also the color-coded candles, what I call grab candles, right at Interbank, and it'll overlay on your Interbank FX Trader 4 platform. And then the 3 other moving averages that I would recommend you add would be the 20 period, 50 period, and 200 period simple moving average. Okay. As far as recognizing the trend or any type of market trend, it goes back to putting your charts within what I call a market memory. And again, there's video on this at the YouTube channel. But each time frame has what I call a market memory. That's what I like to focus on. And within the context of that market memory, I'll look at the angle of the wave, the way the 3 moving averages are traveling, the angle at which they're traveling. And that's why I use these clock angles, 12 to 2 for an uptrend, 4 to 6 for a downtrend, flat 3 o'clock for an accumulation market trend, and then 2 to 4 for the distribution market trend. So the steps are essentially go into the proper look back, the market memory for that time frame, and then assess the clock angle of the wave, the 3 lines of the wave. Sometimes it's easier to focus in on the middle line, the close, and ask yourself, what clock angle, what time is it pointing at? And that's how I determine the market trend. And when market trends are in transition, you know, oftentimes it can be very difficult. But a transitional market is typically best treated as a distribution market trend, or if you've got a very strong preceding trend that, you know, for example, what we had on the euro-US dollar. You know, we had a fairly healthy, although not long, but we had a fairly healthy uptrend that preceded the transition to a sideways market. So I'm not going to get overly bearish on the euro-US dollar as the market starts to go sideways. If anything, it's more of a neutral bullish type opinion of the directional bias. Okay, so even when we start to get into transition with the wave and we start to say, well, I'm not really getting a clear look at what it is the market trend is trying to tell me, in moments of transition, our best approach is to expect some confusion, which confusion means distribution, and then look at the preceding trend if there was one and realize that that is probably more impactful than to assume a reversal. Okay? The between the greens 5-minute videos, I believe that is available at the YouTube channel. I'm almost positive it is, and also it's available right on the Daily Trading Edge. So if you go to the Daily Trading Edge and look at the archives, I've got the 5-minute between the greens. I've got a number of updates that outline the details of my 5-minute between the greens at the Daily Trading Edge, and I believe at YouTube as well. Okay. All right. So I don't assess the angle of the 20, 50, or 200. For those of you that are curious, only the 34 EMA wave. All right. As far as the why of the preceding trend, because that's the psychology that dominated before the transition. You know, if I'm looking at the euro-US dollar, just because we've gone sideways, would I automatically assume bearishness? Or would I consider the fact that even though we transitioned out of the uptrend, there's probably more relevance to that prior psychology than for me to assume an absolute reversal of the psychology? That's the reason I believe that preceding trend is more impactful in those moments of the fresh transitions. I'm not going to just automatically assume a reversal. There's no justification for it, especially until prices can establish resistance below the wave. And with that transition still comes some remnants of traders who saw the preceding uptrend and still might feel slightly bullish in the case of the euro-US dollar. Okay? Thank you everybody for your questions. I think you guys made for a great discussion. I really appreciate your time, and hopefully the idea of directional bias will help you with your time frame selection and recognize when you're trading with the greater psychology versus perhaps maybe fighting it, knowing when to fight the psychology with a shorter term time frame. We have a number of resources we keep available at not only the YouTube channel, but also, again, right on the Daily Trading Edge. I will be in New York for the Expo early next week, so hopefully I'll meet a few of you there. At least that's my hope. For any of you that are in the New York area, definitely come check out the Trading Expo. I'll be at the Interbank FX booth, and I hope to meet you in person. As always, I appreciate your time. I hope not to waste a moment of it, and I hopefully opened your eyes to just another way of looking at the markets and having another tool in your toolbox to help choose your trades more effectively. Thanks for your time, and I'll see you for the next class.